All right, Margin Protections 2018. I'd like to welcome you to this video on margin protection for the 2018 crop year. I am very excited about some of the changes in the program for 2018 and the opportunity to cover how the program works for you in this video. I'm sure there's going to be some questions after you've reviewed the video, and just wanted you to know that I am available anytime to answer your questions and help with understanding of this innovative, relatively new product. I can be reached at the email address on the screen, dave.paul@naoucountry.com, or via telephone at 208-661-4353. QB NAU will also have an updated brochure and other information on our NAU website. This slide basically shows the agenda for the webinar. I'm going to start with a brief overview, and then I'm going to touch on all the changes made in the program by the Risk Management Agency for the 2018 crop year. I'll walk through the MP fundamentals, two simple examples, and then I'm going to close technically with an Excel formatted example that hopefully should help tie everything we discussed together. So it might get a little confusing as we go through the fundamentals, but hopefully with the two simple examples and the more detailed Excel spreadsheet example, everybody should be able to understand this, and we'll get going. So, overview. What is margin protection? Well, margin protection is, like I mentioned, sort of an innovative third-generation kind of product that provides insured growers with a product that protects their expected operating margin. For example, the difference between expected revenue and specific expected costs. If a producer's revenue for the year goes down, their costs stay the same, their margin is going to decrease. If their expected revenue is what they expected, but their costs went up, their margin is going to be reduced. And that's what this product is considering. It's going to take into consideration changes in specific commodity prices, yields of those commodities, and changes in the prices of inputs used to grow the crop. RMA made significant changes with the submitters of the product for the 2018 crop year. There's been a major pilot area expansion for corn and soybeans. And you can see a little note or a little block on this slide where the coverage is available for 2018. In 2017, Iowa corn and soybeans was the only state available. For 2018, the RMA and FCIC Board of Directors approved expansion into Illinois, Indiana, Kansas, Michigan, Minnesota, Missouri, Nebraska, North Dakota, Ohio, South Dakota, and Wisconsin. Rice states, Arkansas, California, Louisiana, Mississippi, Missouri, and Texas remain the same. And the wheat states, the Northern Plains wheat area for spring wheat remains the same as in 2017. The coverage levels were modified. Now they can reach up to 95%, so producers can choose between 70 and 95% coverage levels. There's been a protection factor added to the program, and I'll walk through that as we go through the example. But similar to some other area plans, producers can choose a protection factor or a payment rate, essentially anywhere from 0.8 to 1.2. Another exciting addition to the product is the harvest price option is now available, and I'll walk through that in the example as well. But basically, if the harvest price for the commodity is greater than the projected price, the coverage under the margin protection program would increase commensurate with that increase in price. There were some subtle changes in the calculations of deductibles and the trigger margin, and those have been revised. Nothing significant here, but we will walk through all of those changes as well. This is just a pictorial view of the corn expansion area, and you can see the United States map. That's the 2017 areas. Changed from the state of Iowa to essentially all of the states represented in green and the counties represented in green on the map on the screen. This is the corn expansion area. This next slide is the soybean expansion area. Again, the states and counties where the product has been expanded and now available for the 2018 crop year. This is exciting because it enables us as a company too to further develop our marketing plans and our materials and our systems and so on to provide for prospective clients in a much broader marketing area. Okay, some of the basics. This is kind of some concepts, basics with regards to the program. The first and foremost thing with regards to corn, soybeans, and spring wheat is that margin protection has a fall sales closing date. Obviously, that's different than all of the areas where this product is being piloted for corn and beans and even spring wheat. I caught a lot of people by surprise when this product first came out in 2016, but it's very important now for agents and producers to know the product is available, understand how it works, and have the ability at least to look at this program with their crop insurance agent prior to the September 30th sales closing date for corn, soybeans, and spring wheat. The rice sales closing date varies by state and county, and it's either January 31st or February 28th, which corresponds to the sales closing date for the MPCI products, rice products in those states and counties. For corn, soybeans, and spring wheat, the price discovery for projected prices is in the fall, to correspond with the fall sales closing date. The price discovery periods are August 16th to September 15th for the fall sales closing date crops. For rice, those projected price discovery periods correspond with the MPCI price discovery periods under the Commodity Exchange Price Provision document. Margin protection and revenue protection use the same harvest prices. So the only difference here with regards to pricing the commodities is corn, soybeans, and spring wheat. For margin protection or price in the fall, you have a much larger window for price fluctuation than you do under the revenue protection program. Also, margin protection is area-based. The producer's own costs and own yields do not play any part in this program. The same expected county yield, which will be published by the risk management agency in the actual documents ahead of sales closing, the same expected county yields for the area risk protection pilot technically are used for margin protection. The same methodology established there. As I mentioned, with the changes for 2018, margin protection offers coverage levels from 70 to 95%, and protection factors from 80% to 1.2. It is a unique product. Growers can choose to also buy an underlying MPCI base policy in the spring. If a producer elects to do this, which we would recommend, growers who do so would get a premium credit on their margin protection premium, and they would receive essentially the greater of the margin protection or the revenue protection indemnity in the fall. Very, very important. The MPCI base policy must be with the same AIP. So if we at QBE NAU write the margin protection policy, we must also write the MPCI base policy for that producer for that crop year. Okay, some more margin protection concepts. Prior to the sales closing date, RMA is going to release in the actuarial document a county expected yield. They will release a projected price for the commodity, and they will release expected cost from which the expected margin can be calculated. This is an example on the slide, essentially, where RMA, this was a previous year because these aren't filed yet for 2018, but you can see the margins and the yields that were filed in the actuarial documents for RMA. So prior to sales closing, you'll be able to see the county expected yield, the projected price for the commodity, the expected cost for the inputs subject to price change, and the fixed inputs, and then expected margin is calculated. So the commodity crop or commodity and county will all have the same expected margin. So the only difference between insured producers is what coverage level they elect to purchase. And you go through the year, and at harvest time, RMA will also release a final county yield, a harvest price for the commodity, a harvest cost, to see if those costs went up or went down, and then a harvest margin is calculated. And if the producer's harvest margin falls below their trigger margin, then a payment would kick in. A little bit different view here. The top half of the slide is everything that's done up through sales closing. An expected margin is determined. That's the expected county yield times the commodity projected price equals an expected revenue. Expected revenue, subtract expected cost from expected revenue, you get an expected margin. Again, that expected margin will be exactly the same for that commodity in that county for every grower. Trigger margin will be calculated, which would be the expected revenue times 1 minus the coverage level chosen by the producer. You get a margin deductible. The expected margin minus the margin deductible is the producer's trigger margin. Go through the year, RMA will announce, if you look at the bottom half of the slide, a final county yield and a harvest price. And you get a harvest revenue, basically, which can be compared to the expected revenue. And then RMA will release the harvest cost. You subtract the harvest cost from the harvest revenue, you get a harvest margin. And the harvest margin in the county will be the same for every grower. Trigger margin minus harvest margin is the indemnity. The indemnity times the protection factor the producer selects is the insured's final indemnity. This example is assuming there's no underlying MPCI-based policy. There's a liability calculated. I'm not going to belabor this. It really doesn't have a lot of impact on the program, but essentially it sets a highest level of potential payment on the policy, regardless of the outcome of the county yield, the commodity price change, and the input price change. You can see the calculations on the slide. Following release of the margin harvest price, the liability may increase if the producer selects the harvest price option and the margin harvest price is greater than the margin protected price. But I would say for this purpose, don't worry too much about this margin liability. Okay, expected cost. On the revenue side, the program works a lot like revenue protection. We have expected yield, we have a projected price, we have a final yield, and we have a harvest price. The unique feature of this product is it also pulls in certain expected costs. And again, it makes no effort to measure any individual grower's actual cost. Instead, assumptions are made based on local agronomic conditions to establish a quantity of key inputs. The quantity of the inputs doesn't change throughout the year. The price of those inputs does. These are based on a relationship between expected county yield and the volume of an input needed to grow a bushel. And you'll see this in my following slides. I'll show you how this works. Costs include diesel, nitrogen or urea, phosphorus or DAP, potassium or potash, interest, and then other fixed costs. Okay, we'll start with diesel. And this is a little bit complicated, and it just shows you basically how this is calculated. So again, don't worry too much about this. This is all done in the background, and all these calculations are provided for the companies by RMA. So diesel is based on the New York contract, basically the New York MEX UL SD futures contract. Take an input quantity equals the expected county yield times 0.04 plus 2.5 gallons of diesel. So we're going to work through an example. This is an Allen County example. None of these rates and rules technically have been filed yet, so this is a sort of an arbitrary example, but it should be fairly close to how Allen County, Indiana turns out. So in this case, if you took the expected county yield for Allen County, Indiana, times 0.04 at 2.5 gallons, we arrive at an input quantity of 9.06 gallons of diesel in this county for this input quantity purposes. And then essentially we'll set a price on diesel. That price is off that New York market. And you can actually go on that market and track those prices. And those prices will start being tracked off of RMA's website as well as we get into price discovery. Projected price discovery period for diesel, and essentially all of the inputs subject to price change follow the price discovery period on the projected price side with the commodities, which will be August 15th to September 14th. However, the harvest price discovery period is earlier than the harvest price discovery period for the commodities. So essentially this is bringing us up and through planting typically in most of these areas. So how much diesel it's trying to project the amount of diesel and the price of diesel at the beginning of the year, that same amount in the price of diesel at the end of the year to see if it costs the producer more to put that amount of diesel on at the end of the year. Nitrogen, same process. It's using the Chicago Mercantile Exchange swaps urea contract. Input quantity equals the expected county yield times 0.83 divided by 0.46. Again, this is all done in the background. So this projection, that's all done in the background, says on average in this county, on this expected yield, it would take 295.93 pounds of urea in this county to produce a crop. The commodity will be priced, projected price set in August 15th through September 14th average, and then a harvest price will be announced in late spring. Phosphorus, same, this commodity Mercantile Exchange swaps DAP contract, expected county yield times 0.35 divided by 0.46, average 124.78 pounds of phosphorus per acre, same price discovery periods as diesel and urea. Potassium, very similar, just the calculation a little bit different. Arrive at 68.33 pounds per acre, projected in harvest price discovery periods. Well, the projected price discovery period is August 15th to September 14th, and these prices for potassium do not change, they're fixed as you go through the calculations. Interest is another cost that is very important to growers. It's a little bit complicated. Again, this is all done in the background, but essentially this is based off of that Chicago Mercantile 30-day Fed funds futures contract, which can also be tracked. The input quantity equals the futures rate plus 6%. There's a projected price discovery period and a harvest price discovery period for interest. This goes through the entire year essentially. And this will become much more understandable when I get to the end and go through my final Excel example. I'll show you exactly how interest plays a part in this program. Essentially, if the cost of money goes up, that reduces the margin and could have an impact on whether there's an indemnity payment or not. There's a lot of other costs that are considered that are fixed costs, and they're just used to develop the expected margin. All of these costs are based on extension data from land-grant universities, generally include seed, lubrication, select crop protection products. In this county, for 2018, we're projecting $206.90 of fixed cost. These are not subject to price change. I'll show you how they work when we do our Excel example at the end. Okay, two examples. First, a simple example. Again, we're going to use this Indiana county and those input quantities and prices that we just went through, working our way through the fundamentals. So we're going to start with the beginning of the year and an expected margin. So we're going to assume that the expected county yield in this county in Indiana is 180 bushels per acre. And we're going to assume the projected price for corn is $4 a bushel. And then we're also going to assume when RMA calculated all of those costs, quantity or input costs in quantities, it came up to a total cost of $313.31. So if you subtract that from the expected revenue, you come up with an expected margin of $406.40 per acre. This producer chooses a 95% coverage level. The deductible is done a little bit different. It's expected revenue times 1 minus the producer's coverage level. So again, 180 bushels per acre times $4 times 1 minus 0.95 equals a deductible of $36 per acre. Take the expected margin minus the margin deductible, and the trigger margin for this producer is $370.40. So essentially, the $406.40 per acre expected margin is the same for every grower in the county. The deductible is the difference in the payment rate. So this producer's trigger margin would be $370.40. If the harvest margin comes below $370.40, a payment would kick in, and that payment would be multiplied by the protection factor to determine the producer's indemnity. Okay, you go through the year, RMA will announce a harvest margin, and we're going to assume in this example that the final county yield on corn in this county, Indiana, went from 180 to 160 bushels per acre. And we're also going to assume that the price dropped from $4 to $3.80. And we're going to assume that the cost, the input subject to price change, did not change. So those input costs stayed the same. So essentially, we're going to subtract the final harvest cost from the harvest margin, essentially, or from the harvest revenue to come up with a harvest margin. And that harvest margin is $294.40. Trigger margin minus the harvest margin. Remember, our trigger margin from the previous slide was $370.40. That's at the 95% deductible. The harvest margin is $294.40. So the indemnity technically is $76 an acre. Take that times the producer's protection factor, and in this case, the protection factor was 1.2, so that raises the indemnity from $76 an acre to $91.20 an acre. We're going to do one more simple example, and this is the new feature, the harvest price option under margin protection. So we're going to start with calculating a margin protection trigger. Again, it works the exact same way as the previous example. The only exception being if the commodity harvest price is greater than the commodity's projected price, the expected margin is going to change. And in this case, we are going to assume the price went up. So we take 180 bushels with the expected county yield times the maximum of the projected or the harvest price, and we're going to subtract the expected cost, which were $313.60, and now you arrive at a expected margin of $424.40. Technically, the only thing that changes by selecting the harvest price option. Everything else stays the same. Margin deductible, essentially you take the 180 bushels per acre times the higher of the projected or the harvest price times the deductible equals $36.90 an acre. Essentially, your expected margin minus the margin deductible is $387.50 an acre. The margin harvest price will not be greater than the margin protected price multiplied by 2. So calculate the indemnity works the same way. We're going to assume that in this case the bushels went down from 180 to 160. The price went up to $4.10. The expenses or the input subject to price change did not change. So essentially the harvest margin is $342.40. Trigger margin was $387.50. You subtract the 2, you end up with a harvest or a margin loss of $45.10 times the $1.20 protection factor for a payment to this grower of $54.12. All right. So this is a more detailed example, and this is technically more of a picture of how this really works. So this is the whole gamut. On the left-hand side of the slide is everything at sign-up. On the right-hand of the slide is everything at harvest. And if you look at the blocks in red, those are the things that I've identified here that can change. And this is what technically margin protection is trying to measure. Did the yield change? Did the price of the commodity change? Again, if those one or the other go down, the potential margin for the producer is reduced. Their revenue is down if the price went down or if their yield went down or if both went down. To move down to the second red block, those are all of the inputs subject to price change. And the price per ton or price per unit are the only things essentially that change in those calculations. The other thing that can change that I failed to highlight on this slide is the interest cost. And in this example, they didn't change, but that can change as well. So by the result of either the final county yield or the harvest price changing from what was established at the beginning of the year, or the price per unit of the input subject to price change changes. These are simply the things that are being measured under the margin protection program. And I'll show you the impact of those changes. So we're going to start out, we're going to go back to the beginning of the year. And this is the same exact example that we were just going through in the simplified example. You have an expected county yield of 180 bushels an acre. You have a projected price of $4. You get a revenue per acre, or expected revenue in this county of $720 per acre for corn. The next group of blocks are all the fixed costs. And you can see if you look from left to right, these costs never change. Once they're set, they're set. And they expect to be set for years, hopefully. RMA will make changes in those from year to year if something significant changes in the marketplace. But for the most part, those are fixed costs. They're just used to establish the expected margin. They're not measured in any other way in this program for any kind of change. You move down into where it starts with urea, DAP, potash, and diesel. For corn, these are the four major inputs subject to price change that we will measure. We've set the projected price. We've set the quantities of those. These quantities per acre do not change. If you go from left to right, those quantities are exactly the same. And they will not change during the year. So what we're trying to measure here is, does it cost this producer more or less as you go through the year to purchase these inputs to put into the crop on average in that county? And if the cost or the price of those inputs subject to price change goes up, multiplied by the intended quantity of those inputs, could potentially reduce the margin for the grower and incur a payment under this program. So these will all be set again on the left-hand side of the slide at prior to sales closing. You have total variable input cost of $96.41. You add that to the total fixed cost. So your total cost before interest are $303.31. Do the interest calculation like we showed. Take that times the total cost, and you get $10.28 worth of interest cost per acre for this producer, essentially, to borrow money in this example. Total cost with interest, $313.60. Expected revenue, $720. Expected cost, $313. Expected margin, down here towards the bottom, $406.40. Your margin deductible at 95% is $36. Trigger margin for this grower is $370, just like the examples we just walked through. I don't have the quotes for the total premium and producer premium because the developer essentially, because there were so many changes in this program, took down the quoting software to implement the changes in the program. That should be up and running fairly quickly. You can go off of RMA's webpage and get those calculations and estimates as well. And if anybody has any questions or problems coming up with that, please just let me know, again, with the contact information I provided at the beginning of the slideshow. Okay, so that's all the stuff said at the beginning of the year. So our harvest. Again, basically, the things that can change, final county yield, harvest price, and your price per unit of those inputs subject to price change and your interest. So we're going to assume, basically, in this case, again, just like our example, the expected county yield was 180. The final county yield came in at 160. The projected price was $4. The harvest price came in at $3.80. So they expected, if you look at the left-hand side, they expected $720 in this county basically for an expected revenue in this county in Indiana, but when the final numbers came in, the expected revenue in this area concept plan was $608. So obviously his margins, or this county's margins, shrunk, and that could trigger a payment essentially for everybody in this county, depending upon the coverage level selected. Again, your fixed costs don't change, and essentially, just like my example, I left the price per unit for these inputs subject to price change the same. That would rarely happen. Some of these input prices obviously are going to change between price discovery in the fall and harvest price towards the end of the spring. But in this example, we left these things the same, so you end up with total expected cost 96, total fixed cost 206. So you have total cost before interest of 303, and I didn't make any change in the interest calculation. But if that interest calculation changed and the interest cost went up, you multiply that times the actual subject or actual variable and fixed cost to come up with an interest cost that's going to be added to the final cost. So essentially, total cost before interest in this example, $303. With interest, $313, same as the projected cost, no change. Harvest revenue was $608. Harvest cost, $313, essentially. Again, you had a trigger margin of $370.40. Harvest margin basically is $294 if you subtract 313 from 608. You come up with $294, which is well below the $370 guaranteed or trigger margin. Margin loss in this case, $76 an acre. Protection factor of $1.20. The indemnity for this producer would be $91.20 an acre. So again, this example is just assuming two variables change. The variables, again, just to reiterate, that can change are final county yield, harvest price, price per unit of urea, DAP, potash, and diesel, and your interest cost, and the calculation surrounding those variables changing will determine whether or not any kind of loss payments would be made under the margin protection program for the 2018 crop year. Premium credit. If a grower buys a margin protection policy in the fall on corn, soybeans, or wheat, or in the late winter, early spring on rice, so if they buy a margin protection policy on one of the pilot crops, and then they subsequently buy a base policy, base yield protection, or revenue protection policy in the spring, remember they have to be with the same AIP, a TB NAU. It cannot have an MPCI policy with, or a margin protection policy with NAU and an MPCI policy with another approved insurance provider and be eligible. That MPCI policy would have to be moved to the company that had the margin protection policy in the fall, because that's the first policy selected for the year. The insured may only receive the greater of the revenue protection or margin protection indemnity. In other words, if there's a margin protection indemnity and there's a revenue protection indemnity, the revenue protection indemnity is going to be subtracted off of the margin protection indemnity to determine whether an additional payment will be made for margin protection. There is a premium credit that applies to the margin protection premium, because that base RP policy or YP policy essentially is going to be offset against the margin indemnity. So that premium credit will be calculated when the producer purchases and reports their acres on their MPCI base policy. There is an estimator tool that's available on the website that's shown on this slide. It can be linked off of RMA's website as well. The credits and actuarially determined value of the expected overlapping indemnities between a producer's margin protection and revenue protection at the time of revenue protection sales closing. That estimator is going to actually look at the producer's APH yields for the commodity insured under margin protection and MPCI to do those calculations. So that premium credit is going to vary depending upon the insured in the county that they're in. Some timelines for margin protection. This is particularly dealing with the early crops, corn, soybeans, and wheat. By July 1st, the premium estimates should be updated weekly. September 15th, and the price discovery. Again, you can go online just like on MPCI revenue protection and monitor throughout price discovery where those prices lined up, both on the input side and on the commodity side. Of course, the sales closing date is September 30th. By March 15th, for corn, soybeans, and wheat, base policy sales closing date, premium credits can be estimated. You can actually estimate those premium credits ahead of that. You can estimate those prior to the September 30th sales closing date. July acreage reports on MPCI premium credits are finalized. In October, the harvest prices are discovered. In production reports, November, potentially right around October, November, revenue protection indemnities determined. And then it won't be until the following February or so before the margin protection indemnities can be determined, because we'll need to wait for that final county yield. Okay, that technically sort of summarizes the margin protection program. I hope this helped. I know it's quick and sort of dirty here, but we're going to have a lot more information available on margin protection. Hopefully we'll be presenting presentations like this. There are agent update meetings and so on. But this should get a person a start in understanding margin protection. And of course, if you have any questions, don't hesitate to contact your marketing representative or myself, and I'll help you, and they'll help you any way we can. I appreciate your time. I'm excited about margin protection. We're getting a lot of interest this year and looking forward to the marketing season. Thank you very much, and have a good day.